Hello everyone, this is Bhutani with Remax Excellence.
Hi everyone, this is Sid. I'm a mortgage specialist with Mortgage Alliance.
So we will be talking today about low mortgage interest rates being offered by lenders. What should we be looking at as buyers out in the market when we go to a lender and when we get offered a low interest rate, what we should be looking at? What are the terms and conditions? What are the penalties? Because that's a big part in a mortgage commitment. A lot of times we think that we will be buying this house and will be staying here for the next 5-10 years, but that does not happen a lot of times. You could move sooner than what you have anticipated, right, in the past. So Sid will be talking more about what the penalties could be, what is the downside, what are key terms in a mortgage commitment letter that you should be looking at and you as buyers should be aware of before you sign on those papers.
I've been wanting to do this this video for quite some time now, and I think it's very important for our viewers to know that the lowest interest rate being offered out in the market does not mean that it is the best mortgage that is available for them. A mortgage has multiple factors and multiple terms and conditions that we all should look at. Now, a contract is too lengthy for us to go through the whole contract right now on this video. However, there are some key points that I would like to highlight that we all should be looking for. The first one, of course, is interest rate. I'm not saying that you should go ahead and get a higher interest rate or whatever, but that is not the only point. There are two other very key points that we should be looking at. One is the prepayment privileges. So let's say if we have extra money down the line, let's say if you want to make some lump sum payments. Now there are banks who would allow us to make only 10% lump sum payment of our mortgage amount every year, and then there are banks who would allow up to 20%. So, we all can win lotteries, we all can have some spare funds, some savings that we may want to put against our mortgage, and we don't want to be penalized on it. So that's a very important condition. And the second or the third most important condition that we should look at is what are going to be our prepayment penalties or prepayment charges if in case we were to break our mortgage sooner than the 5 years that we have committed for. So in order to do that, I'll be showing a small example to all our viewers today to, that would give them an explanation on why the lowest rate may not be the best mortgage for them. So this year, despite COVID, the real estate market is showing signs of life. And the usual big banks have started marketing low interest rate teasers. Every day we'll look in, on internet, on our Facebook or whatever. Oh, this bank is offering 1.99, the other bank's offering 1.85 variable and all of that stuff. And the key point to note is that banks are offering these low rates only on mortgages where the client is putting less than 20% down payment. And the most common question that clients come to me asking is, well, I'm putting 20% down payment, why am I not getting the lowest interest rate? And that is because there is a thing called, that we all know as CMHC insurance fee. So every time the money being lended by the bank, if it is insured, the bank does not have as much risk as it would have if it is not insured. And therefore banks end up offering a lower interest rate on mortgages that are insured. So coming up with 20% does not mean you're getting the best mortgage rate, right? Going on to the next slide here, on this slide, I'll use an example to illustrate why the terms and conditions in your mortgage contract can end up costing you much more than a small difference in rate over time. Your terms and conditions dictate how much flexibility you have over the length of your contract. Most Canadian borrowers opt for fixed rate mortgages for peace of mind, but a lot can change during the mortgage, like job transfers, career changes, job losses, changes in family structure, or the simple desire to trade up. This is where mortgage penalties come into picture. In a fixed mortgage, you end up paying higher of the two formulas for calculating penalties. First is a 3-month interest formula, and the second one is called interest rate differential. While every lender uses the same basic wording, the devil lies in the differences in their detailed calculations. Now, in June 2020, which is not even a month ago, we all heard in the news that there is a single mom in Ontario who was charged $30,000 in penalty, and I'm talking about less than a month ago, guys. So she got into a house 19 months ago, and she still owed $591,000, and due to COVID-19, she ended up losing her job. Now she did not want to sell the house. However, just because of her not being able to afford the mortgages anymore, she was forced to sell the house, and the bank ended up charging her $30,000 in penalties. So I'm not saying every mortgage is like that or every bank has these rules or whatever, but every bank calculates the penalties differently. And when we are getting into a mortgage, we just have to make sure that the way of calculating penalties, we are aware of it. So if things were to go sideways, we know how much penalty we all can get into. Now here is an example that I've put on this slide here for you. So assuming, so what we're doing is we have two columns, right? On one side you have a mortgage, lower interest rate with bad terms and conditions, and on the other side, the right hand side of your screen here, you have a mortgage for the same amount with slightly higher interest rate but with good terms and conditions. So the interest rate that we are comparing here is 1.99 and 2.14%, so we're talking about 0.15% higher interest rate. The monthly payment goes up by $27 a month, which means over the 5-year term that you're signing for, you will be paying $2,612 more than you would have paid at 1.99% with bad terms and conditions. However, things change here. If for any reason you were to sell the house, let's say in 2 years from now, that is 2 years after you got into the mortgage, to a bank with good terms and conditions, you would pay a penalty of less than $2,000, whereas for the same mortgage, just because you ended up paying 1.99%, a lower interest rate, but with bad terms and conditions, you will end up paying a penalty of $23,049, which means you are paying $21,051 more on penalty that you could have saved by just paying $2,612 extra. Here, guys, I'm actually going to get to another example, and I'm using very average numbers looking at the Edmonton market. So assuming the average purchase price in Edmonton of $350,000 with 5% down payment, which is $17,500, the mortgage insurance fee that we end up paying, now we don't have to pay this up front along with the down payment, but it gets added onto our mortgage amount, just like the way you see it here. The amount comes to $345,800. That is the mortgage amount. Amortized over 25 years, assuming that we paid, or like a couple of years ago, we got into a mortgage at 2.69%. Our monthly payments were $1,582. Now, for some reason, we are 3 years into the mortgage and now we have to sell the house. Now let's look at what penalties are we looking at. So I'm looking at a mortgage penalty calculator here. This is available on ratehub.ca. All I did was I went onto Google and I searched for mortgage penalty calculator. The first link you would get would be for this one. And here what I've done is I've entered the date, which is 3 years from now, saying that this is like 3 years ago, I bought the mortgage for $350,000 with 5% down. My mortgage balance after 3 years is $315,431. Because it was a 5-year term, I've selected 5 years here. It's a fixed rate mortgage. The interest rate that I signed up 3 years ago was 2.69%. And of course the property was in Edmonton, Alberta. Now, here you will see there's an option for where we can select the banks to see which bank, and now this is not the exact penalty. Every bank has their own formulas and these formulas will change over a period of time. However, this tool gives us an option to see what different banks would charge us for penalty 3 years down the line if we were to break a mortgage. So here for the first example, I'm not going to name the banks here, but the first bank that I'm going to select here, the monthly payment the mortgage penalty will be as high as $9,147. And mind you guys, this is 3 years into a 5-year term and we have to break it. Going to the second bank, the penalty will be $12,061, which is approximately $3,000 more than the other bank we had selected. Similarly, going to a couple of other banks, this bank has about $2,121, so this is about $10,000 lower than the bank that we just looked at. So the point here is, and of course you can, there are multiple banks, you can go through it. Like for example, with this bank it'll be $5,362. So even though your terms and conditions or your mortgage contract will still say the same terms for penalty, which is 3 months interest or interest rate differential, the point lies in the fact as to how do you calculate your interest rate differential. Are you giving us discounted rates upfront from what your posted rates are or not? That is what tells us how much penalty we will end up paying when the time comes to break the mortgage.
Great, Sid. This was really good information.
Yeah, and I just fail to understand why mortgage is something that we all are living with in our lives, and we still are not educated properly on it. We all and it's a big commitment that we guys get into, right? So I think it's very important for us to learn the nitty-gritties, to learn the very basics, to make sure that we are not being penalized way more than what another bank would have penalized us for.
Great, Sid. That was really good information.
Yeah, well, I'm glad I could put this through for our clients here because interest rates, guys, is not the only thing. Look for the terms and conditions. Make sure you're not being forced to pay a higher penalty in a time when you really have to sell the house.
Yeah, I completely agree, Sid. And you know what, this is coming from me. Like I have been doing real estate for a bit. And the fact that when I go and meet people, they thought initially that they'll be in this property for at least 10-15 years, and you never know, things change, priorities change. You might have to move out of town, you might have to just upsize or maybe downsize, whatever the reasons are. So this is one term in a contract. When you do sign a mortgage commitment with any lender, just do not look at the interest rate only. Look into the other terms as well, because they really have a big role to play.
You're absolutely right. I hope this video would have been able to give you some insights about these terms and conditions. If you still have more questions, you can always give us a call. Our numbers are displayed on the screen. We are always here to help you guys.
Okay, perfect. Thanks for watching our video.
Thank you.
Until next time.
Have a good day. Take care. Bye.